You know that moment when you pull up to the gas station and your stomach drops before you even look at the number? You already know it's going to be bad. You can feel it, and then you see it. $3.70, $4.20, $5.30 if you're in California. You stare at it for a second, and then something interesting happens inside your brain. It files it. Annoying, manageable, moving on. Stay with me because what I'm about to walk you through will completely change how you see what's happening to your money right now. Because that number on the gas station sign, that's not the story. That's just the first sentence of a story that has 5 chapters. And by the time most people figure out what they're actually reading, 4 of those chapters will have already happened to their wallet. If this is landing for you already, subscribe. There's a lot more to unpack. Here's the thing: your brain is actively working against you right now. And that's not a character flaw. That's 300,000 years of evolution running the wrong software for this particular moment. Let me show you exactly what I mean. Higher gasoline and diesel prices are now costing the American economy an additional $500 million every single day. Not per month, not per quarter, per day. And that number is climbing. Since late February, when the United States and Israel launched strikes on Iran, the price of oil has surged over 50%. The Strait of Hormuz, a 21-mile-wide channel that carries 1/5 of the world's crude oil and natural gas, has been effectively shut down for the first time in history. Brent crude is trading above $110 a barrel. 3 weeks ago, it was $70. But the price at the pump, the number you're staring at every time you fill up, that's actually the smallest piece of what's coming. There are 4 more waves of price increases heading toward your wallet right now, each one bigger than the last. And most people won't see any of them coming until it's too late to prepare. What I'm about to walk you through isn't just what's happening to the economy. It's why your mind is actively working against you right now, and what that's going to cost you if you don't override it. Let's start with what you can already see. Gas prices. The national average has jumped from under $3 a gallon to $3.70. In California, drivers are paying over $5.30. And diesel, the fuel that powers the 18-wheelers that deliver literally everything you buy, has surged 36% to nearly $5.10 a gallon. The average American household spends about $2,500 a year on fuel, roughly $50 a week. If you're suddenly paying $10 or $15 more per week, that doesn't sound catastrophic on its own. So your threat assessment system files it under annoying but manageable and moves on. That filing is wrong. And here's why that matters more than you might think. Psychologists use a concept called mental accounting to describe the way we unconsciously separate money into invisible buckets: gas, groceries, entertainment, savings. Richard Thaler at the University of Chicago, who won the Nobel Prize in economics for this work, found that when one of those buckets suddenly overflows, we don't sit down and calmly redistribute. We emotionally react. We slash whatever feels optional.
Dining out disappears. The gym membership gets canceled. That trip you were planning evaporates. The investment contribution you told yourself you'd increase this year quietly stays where it is.
The chief economist at the National Retail Federation confirmed exactly this pattern. When gas prices spike, the first casualties are experiences: movie theaters, theme parks, restaurants. Not because those things got more expensive, because your survival instinct reclassified them as luxuries the moment a mandatory expense jumped. You're not irrational for doing this. You're running the same mental software as everyone else on the planet. And that software is about to get a lot louder because gas is just wave 1. And here's where it gets really interesting. Nobody is framing this correctly yet. The war's economic impact isn't one price spike. It's a rolling series of shocks arriving on different timelines, each one compounding the last. By the time most people recognize the full picture, 4 of the 5 waves will have already hit. Wave 1 you already know. Gas. It showed up within days. Wave 2 is landing right now. Groceries, specifically the perishables, produce, meat, dairy. The things that can't sit in a warehouse waiting for prices to stabilize. Diesel powers the refrigerated trucks that bring those items to your store. And a 36% diesel spike means the cost of moving perishable food just went vertical. Supply chain researchers confirmed that grocery stores will be the first place consumers see higher prices outside of gas stations, and the less shelf-stable the item, the more exposed it is. But retailers won't raise prices overnight. They'll absorb the costs for a while, just like many did with tariffs over the past year. The problem is they've already been absorbing tariff costs. There's almost no margin left to cushion a second shock. One economics professor at Boston College warned that if oil prices stay elevated for any meaningful period, you'll see a persistent cost shock that businesses simply can't eat anymore. And when they stop absorbing, the sticker price catches up fast. Wave 3 won't arrive for months, but it's already baked in. Fertilizer. This is the wave that should genuinely concern you because it operates on a delay that makes it almost invisible until the damage is done. Fossil fuels account for up to 80% of fertilizer production costs. The countries directly impacted by this conflict, Iran, Qatar, Saudi Arabia, Bahrain, and the UAE, are among the world's top fertilizer producers, and 1/3 of the global fertilizer supply passes through the Strait of Hormuz, the same waterway that's currently shut down. So the food you eat in September and October is getting more expensive right now because of inputs that farmers are paying a premium for this month. You won't feel this one until fall. By then, it'll be too late to prepare for it. And by then, most people will have forgotten that the seeds of that price shock were planted in March. And the crazy part is, this is the wave that almost no one sees coming in real time. Not because it's hidden, because it's delayed. Because your brain is designed to connect visible causes to visible effects, not invisible inputs to future grocery prices 3 seasons from now. Wave 4 is airfare. Jet fuel has surged roughly 85% since the war began. Airlines from Qantas to SAS to India's biggest carriers have already announced fare hikes. And unlike gas, which fluctuates daily, airlines bake fuel costs into their pricing models months in advance. Those higher fares aren't coming down fast, even if oil drops tomorrow. If you're planning a summer vacation, your ticket prices are about to hurt. Wave 5 is the one almost nobody has connected yet. Interest rates. The Federal Reserve was expected to start cutting rates this year, which would have lowered borrowing costs on mortgages, car loans, and credit cards. That expectation is dead. Some economists now project the first rate cut won't happen until the 3rd quarter at the earliest. If inflation accelerates further, rates could go up. If you were planning to buy a home or refinance, the math just changed underneath you. One leading economist warned that when inflation shocks collide with geopolitical uncertainty, consumers don't just cut spending. They freeze. People delay cars, homes, renovations, not because they can't afford them today, but because they've lost confidence in what they can afford tomorrow. And when millions of households freeze simultaneously, that collective pause can drag the whole economy down with it. So let me ask you something. When you first heard that oil prices spiked because of the Iran conflict, how many of these downstream effects did your mind immediately connect? 1, maybe 2? You're completely normal. And that normality is exactly the problem. Here's the thing most people miss. There's a well-documented phenomenon in behavioral psychology called anchoring bias. When you encounter a complex, multi-layered problem, your mind doesn't process every layer simultaneously. It grabs the most visible data point, and uses that as a stand-in for the entire situation. Daniel Kahneman at Princeton, whose research on this cognitive pattern won the Nobel Prize in Economics, showed that once an anchor is set, it becomes remarkably resistant to adjustment, even when new information clearly demands it. Right now, for most Americans, that anchor is the number on the gas station sign. $3.70, $4.20, $5.30, whatever it is in your area. That number has become the proxy for the entire economic impact of this war. And because gas prices feel annoying but survivable, your internal threat assessment files the whole crisis under temporary inconvenience. Meanwhile, one leading economist estimated that the gas price spike alone could push monthly inflation to 1% in March, the highest monthly increase in 4 years. Annual inflation would approach 3%. But here's something several viewers asked about, and it's a fair question. How does 1% monthly become 3% annual? Because economists aren't projecting that this level of inflation holds for 12 straight months. The 1% spike is the acute phase. What follows is a slower elevated baseline, as the grocery shock, the fertilizer shock, and the airfare shock work their way through the system. That's how you get to 3% annual, not by multiplying, but by understanding the shape of the curve. And that's before the ripple effects through every consumer good that needs to be transported anywhere. The International Energy Agency called this the greatest global energy security challenge in history, not a moderate disruption, the greatest in history. And your anchoring bias is comparing the number at the pump to last month and whispering, "We'll manage." This is precisely what happened in 2022 after Russia invaded Ukraine. Gas prices spiked, people grumbled. Then the shock bled into groceries, rent, services, everything. Inflation hit 9%. By the time most people grasped the full scope, the damage to their purchasing power was already done. You're not irrational for missing this. You're not bad with money. You're running the same mental software as everyone else, but recognizing that software is the first step toward overriding it. Now, let's talk about what's keeping people up at night: your investments. The S&P 500 has dropped nearly 7% from its January peak. That alone is unsettling. But zoom out and the damage runs wider than any single index. The Dow just posted 4 consecutive losing weeks, its longest streak in 3 years. If you own index funds or target date retirement funds, you felt this. The Nasdaq briefly dipped into correction territory, falling nearly 10% from its high, dragged down by tech stocks that were supposed to be the growth engine of 2026. And the Russell 2000, which tracks smaller companies more sensitive to interest rates, officially crossed into correction last Friday, down more than 10% from its January high. The energy markets tell their own story. Brent crude surged to nearly $120 a barrel before pulling back to settle at $112 on Friday, its highest close since 2022. Gold, which everyone assumed was the safe haven, spiked above $5,400 per ounce, and then crashed more than 10% in a single week, its worst performance since 1983. Even the safe plays aren't behaving the way people expected. Wall Street's fear gauge, the VIX, surged from the mid-teens to nearly 32. When you absorb all of that at once, something happens in your nervous system. Your amygdala, the part of your brain responsible for threat detection, starts screaming one word: sell. Get out. Protect what's left. This is loss aversion at work. Research from Princeton demonstrated that the psychological pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. A $5,000 portfolio loss doesn't feel like a $5,000 problem. It feels like a $10,000 emergency. Not because you're bad at math, Because your nervous system evolved in an environment where losses could be fatal. That wiring hasn't been updated for 401 KAs. But what actually happens when people act on that impulse during a geopolitical crisis? According to an analysis by RBC Wealth Management across 20 major post-World War II military interventions, the S&P 500 fell an average of 6% during the conflict. Another study spanning 40 geopolitical events over 85 years found the average first-month loss was just 0.9%, followed by a 3.4% gain over the next 6 months. The pattern is remarkably consistent. The people who sold in panic locked in their losses. The people who held through the turbulence captured the recovery. During the market crash in March 2020, 57 days later, the market was back to where it started. Then it kept climbing. Many of the people who panic sold at the bottom never got back in. They sat on the sidelines waiting for certainty that never came, while the recovery happened without them. And here's where it gets genuinely cruel. The market's best days and worst days cluster right next to each other on the calendar. Miss just 10 of the best trading days over a 20-year period, and your returns get cut roughly in half. Miss 20 and you barely beat inflation. You cannot capture the upside if you fled during the downside. Behavioral economists call this the behavior gap. The difference between what the market actually returns and what the average investor actually earns. That gap exists almost entirely because people buy when they feel optimistic and sell when they feel afraid. The exact opposite of what works. Not because they lack intelligence, because they're running ancient software in a modern financial system. I'm not going to sugarcoat this, though, because there's a scenario that keeps serious economists genuinely worried. Stagflation, rising inflation, and slowing economic growth happening at the same time. It's the worst-case scenario for your money because the tools that fix inflation, raising interest rates, also crush growth, and the tools that stimulate growth, lowering rates, make inflation worse. There's no clean exit. The Fed is already stuck. They left rates unchanged at their most recent meeting because the war has made the path forward impossibly complicated. Cut and you pour fuel on accelerating inflation. Raise and you risk tipping an economy already buckling under energy costs into a full recession. If the conflict drags on and the Strait of Hormuz stays disrupted, some analysts project Brent crude could approach $130 a barrel. At that level, we're past inconvenience. We're into structural damage to household budgets, consumer spending, and corporate earnings. The 1973 OPEC oil embargo is the comparison analysts keep reaching for. Every major oil price shock in the last half-century has been followed by some form of recession. The 1973 embargo led to a 2-year economic contraction. The 1979 Iranian Revolution doubled oil prices and triggered another recession. The 2008 oil spike preceded the financial crisis. The pattern is so reliable that some economists consider oil shocks one of the few dependable triggers for stagflationary conditions. And the current disruption, with oil production across Kuwait, Iraq, Saudi Arabia, and the UAE collectively dropping by at least 10 million barrels per day, is being described as the largest supply disruption in the history of the global oil market. That's not a sentence that gets used lightly, and it should change how seriously you take what's happening, regardless of what the number at your local gas station says. And here's what most people don't realize. Even when this eventually resolves, relief won't be instant. Economists describe what's called the rockets and feathers effect. Prices shoot up like a rocket when costs rise, but drift down like a feather when they fall. After Russia invaded Ukraine, gas spiked within days. It took months to come back down. After hurricanes wrecked Gulf Coast refining in 2005, the same pattern. Spike was immediate, recovery was glacial. So even in the best scenario, where the strait reopens and oil flows resume, You're looking at weeks of ramp-up for production facilities, months for prices to drift back to normal, and a long tail of elevated costs rippling through the supply chain. The Strategic Petroleum Reserve release, 172 million barrels from the U.S. alone, the largest in IEA history, buys time. It doesn't fix the rupture. All right, deep breath. Let's talk about what you can actually control. Because the difference between people who come out of economic shocks stronger and people who come out weaker has almost nothing to do with what happened. It has everything to do with what they did while it was happening. The most important thing right now is to not panic sell your investments. I know every instinct is telling you to move to cash, but research from multiple financial institutions consistently shows that this is the single most expensive mistake investors make during geopolitical crisis. One certified financial planner put it this way: wars can last several years, but most people's investing time horizon is decades. Moving 100% to cash doesn't eliminate risk. It replaces market risk with inflation risk and opportunity cost. There is no risk-free option. Even being too conservative is a risk, because you can outlive your money. Next, pressure test your emergency fund. Financial advisors typically recommend 6 to 12 months of expenses in something accessible, like a high-yield savings account. The top high-yield accounts are paying over 4% right now. If your cushion is thin, this is the moment to build it, not because the worst case is guaranteed, but because the psychological security of knowing you can absorb a shock is the most underrated financial tool there is. Think about it this way: when you know you have runway, you don't make panic decisions. That calm is worth more than the interest. Think of your emergency fund less as a savings account and more as an insurance policy against your own fear response. The cost of not having it isn't just financial, it's psychological. It's the difference between watching the news and feeling concerned versus watching the news and feeling desperate. Desperate people make expensive mistakes. Now, I want to be direct about something here, because several people watching this are thinking, what emergency fund? I'm already stretched. And I hear you, genuinely. The advice to build 6 months of expenses lands differently when you're already making zero-margin decisions about which bill to pay first. You're not broken for being in that position. That's not a personal failure. That's the reality of wages that haven't kept pace with a decade of cost increases. If that's where you are, the most important move is still the smallest possible version of the same principle. Not 6 months overnight, 1 week, then 2. The goal is any buffer at all, because even a small margin between you and the next emergency changes how clearly you can think. Then audit your spending before the next waves arrive. Gas is already here, groceries are coming, airfare is coming, the interest rate repricing is coming. If you wait until all 5 waves have landed to adjust your budget, you'll be scrambling reactively instead of moving proactively. Cut the discretionary spending now, before you have to. Redirect those dollars toward financial cushion. If you're investing on a regular schedule, keep doing it. I know your gut says stop throwing money into a falling market, but this is backed by decades of evidence. When you invest a fixed amount every month, you automatically buy more shares when prices are low and fewer when prices are high. The volatility that feels terrifying right now is quietly lowering your average cost per share. Behavioral economists call this dollar cost averaging, and it works precisely because of the chaos, not despite it. Years from now, the shares you bought during this conflict will likely be some of the best investments you ever made. The people who paused their contributions during past crises missed the discount and bought back in at higher prices. And finally, map your specific exposure to energy prices. This one is personal and looks different for everyone. If you're commuting long distances, the math on a more fuel-efficient vehicle just changed. If you're carrying higher interest credit card debt, Attack it now. The Fed isn't cutting rates anytime soon, which means your borrowing costs stay elevated longer than anyone expected 6 months ago. Every dollar of revolving debt you carry through this period is more expensive than it was before the war started. And if you're a small business owner moving physical goods, your shipping costs just jumped. Now is the time to renegotiate contracts, consolidate shipments, or find closer suppliers before the diesel surcharge eats your margins. Here's something that separates the people who come through periods like this financially intact from the people who don't. And it's not what you'd expect. It's not about being smarter. It's not about having more money. It's about response time. Research on past economic shocks, the 1973 oil crisis, the 2008 financial collapse, the 2020 pandemic, the 2022 inflation surge, reveals a consistent pattern. The households that fared best weren't the ones with the highest incomes. They were the ones who adjusted earliest, who recognized the signals before the full impact arrived and made small, unglamorous moves, trimming discretionary spending, fortifying savings, maintaining investment contributions, reducing high-interest debt. None of those moves are dramatic. None of them make for exciting stories. Nobody posts on social media about the time they moved $200 a month from dining out into a high-yield savings account. But that's exactly the kind of invisible adjustment that creates real financial distance between people who were prepared and people who weren't. Compounded over the 6 to 12 months that an economic disruption typically takes to fully cycle through the system, those early adjustments create an enormous gap. Not because the individual moves are large, because they started before the pressure arrived. You're watching this right now. You're thinking about your money, your budget, your portfolio, your exposure. Most people won't think about any of this until the 4th or 5th wave has already hit their bank account. By then, the window for proactive adjustment is closed. Your window is open right now. You're not irrational for feeling anxious about what's happening. That anxiety is the correct signal. It means you're paying attention. The mistake isn't feeling the fear. The mistake is letting the fear choose for you. Panic selling, freezing, pretending it'll blow over. Those are the responses your nervous system was built for. And they are exactly wrong for this moment. The right response is quieter. Review your budget, check your emergency fund, continue your regular investments, map your energy exposure. And then once you've taken those steps, give yourself permission to stop doom scrolling the financial news. The headlines are designed to amplify fear, not inform action. You've already taken the action. You don't need the fear. You've navigated uncertainty before. You'll navigate this one too. The only question is whether you'll let the disruption make your decisions for you, or whether you'll make them yourself. Are you the type who adjusted early, or are you just now starting to connect the dots? Tell me in the comments. There's more going on with your money and your brain than one video can cover. I'll see you in the next one.